Most people spend 10 years saving $50K for a down payment, but the fastest homebuyers I know, they're earning $300 a month in dividends from stocks under $20, cutting their timeline in half. Hey, I'm your name from Brick and Dollar. And if you've been watching home prices and mortgage rates and feeling like homeownership is a fantasy, I've got a different strategy that actually works. Here's the uncomfortable truth. Traditional saving is dead. You put $500 a month in a savings account, earning 0.01%, and after 5 years, you have $30. Congratulations, that's not a down payment in most markets. That's a joke. But what if I told you that same $500 could be working for you in dividend stocks, generating an additional $200 to $400 a month in passive income? Suddenly, you're not saving, you're accelerating. Let me show you exactly how this works. And we're starting with the stocks that are actually paying these yields right now. First, let's talk about what high-yield dividend actually means. Most blue-chip stocks pay 2 to 3%. But if you dig into the mid-cap and smaller dividend growers, you find 6 to 10% yields. And yes, they're trading under $20. This isn't luck. This is market inefficiency. Bigger investors are chasing Apple and Microsoft. You're looking at the stocks that actually fund your down payment. Let's get specific. I'm not a financial advisor, but I'm showing you the categories where these exist. Energy stocks. Companies like Lone Star Resources and similar midstream players are paying 7 to 10% because of the infrastructure plays and commodity hedging. The math: if you buy $2,000 worth at a 9% yield, you're earning $180 a year or $15 a month. Boring? Yes, compound that over 48 months. That's $1,000 in dividend income on top of any appreciation. Second category, REITs, real estate investment trusts. Here's the irony. You're using dividend income to buy real estate while you're literally being paid to own real estate through REITs. Alpine Income Properties, Lexington Realty Trust, trading under $20, paying 6 to 8% yields. You're getting paid every quarter just for holding them. And they're tax advantaged because REIT dividends have different treatment than regular stocks. Third, preferred stocks. These are the boring, unsexy cousins of common stock, and that's why they yield 6 to 9%. They're traded like bonds, less volatility, boring, perfect. Less people chasing them means better prices for you. Now, let's do the actual math that matters, the down payment acceleration. Scenario: you're 35 years old. You have $10 to invest right now. You want a $20K down payment in 3 years to beat rising rents in your market. Your plan: you save $500 a month, and you invest that $10 in a diversified basket of the dividend stocks we're talking about. Month 1, you have $10K in dividends earning 8% annually. That's $67 a month. Your new $500 adds to it. Month 2, now you have $10,500 earning $67. By month 24, you've saved $12,000, but your dividend income has grown from $67 to $140 a month because the pool is bigger. By month 36, you're sitting at $18,000 saved plus $2,400 in cumulative dividend income. That's $20,400, your down payment. Without dividends, you'd have $18,000. You'd be short. That's not life-changing math. That's game-changing math. Chart showing divergence. But here's what most people miss. Dividend income is compounding differently than your savings account. When you reinvest dividends, and you absolutely should, you're buying more shares, which generates more dividends. The first $10 generates $800 in year 1. If you reinvest it, year 2 your base is $10,800, generating $864. This is the force that turns a down payment from maybe to absolutely. Now, the warnings I have to give you, and this is important, not all high-yield stocks under $20 are created equal. Red flag number 1, a yield that's too high. If a stock is trading under $20 and yielding 15%, ask yourself why. Usually it's because the company cut its dividend and the price hasn't caught up. The stock is a value trap. You're not getting a deal, you're catching a falling knife. Red flag 2, debt levels. Check the company's balance sheet. High debt plus high dividend equals unsustainable. The dividend will get cut, the stock will tank, and you lose. Red flag 3, no growth. These need to be companies that are growing their dividends. A 7% yield that's been frozen for 5 years is risky. A 6% yield growing 8% annually, that's a compounding machine. Cut to you speaking directly. Here's the version of this strategy that most people don't talk about: the psychological advantage. You know what it feels like to check your brokerage account and see $147 in new dividend income that you didn't have to work for? It's not about the money. It's about the proof that your plan is working. Every dividend notification is evidence that you're actually going to own a home. That's powerful. That changes behavior. People who see their dividends growing month to month don't bail on their plan when the market drops 10%. People who feel like they're making progress don't give up. Now, the tax thing, because this matters if you're serious. Qualified dividends are taxed at long-term capital gains rates, 0%, 15%, or 20% depending on income, instead of ordinary income rates. If you're in the 22% bracket and these are qualified dividends, you're saving 7 percentage points on taxes. That's another $15, $20 per month in your pocket on a modest dividend portfolio. Over 3 years, that's $500 to $700 extra. Again, not life-changing individually. Compounding, it changes everything. Let me give you the actual next step, because information without action is just entertainment. Step 1. Open a brokerage account if you don't have one. I recommend one with low or zero commissions. Vanguard, Fidelity, Charles Schwab, all solid. Step 2. Research the dividend stocks in the categories I mentioned: energy, REITs, preferred stocks. Look specifically for 1. Yield above 6%, 2. Dividend growth in the last 3 years, 3. Debt-to-equity ratio below 1.5, 4. Stock trading under $20. Step 3. Don't go all in on one stock. Build a basket, maybe $2,000 in energy, $2,000 in REITs, $1,000 in preferred stocks. Diversification protects you when one sector gets hit. Step 4. Set dividends to reinvest. Don't take the cash, let it compound. Step 5. Add to it systematically. Every month, buy more. Watch your passive income grow. Back to direct camera. By next year, you won't be checking your account and asking, when will I be able to afford a home? You'll be checking it and asking, will home prices drop before my dividend income reaches my target? That's the mindset shift. The housing market isn't getting easier. Mortgage rates might stay high. Home prices might stay stupid. But what you can control is your down payment timeline through compounding income. And that changes everything. If this strategy